Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. The rate cut dream evaporates as sticky inflation rocks Wall Street. Futures are mixed, masking a brutal rotation. Will tech giants hold the line at the bell, or will the market's hidden fragility be exposed? Second, US-China tech war's stunning reversal. Nvidia's H200 sales to China approved, but a shocking 25% revenue tariff triggers a high-stakes gamble. Nvidia is surging in pre-market, but is this a genius move to reclaim market share, or a trap that surrenders profits? Watch for the opening reaction as traders decide if this is a win for Nvidia or its rivals. Finally, Trump versus America's biggest banks. A battle ignites over a 10% credit card rate cap, threatening a credit market bloodbath. JPMorgan is preparing for war, but the hidden victims could be airlines and retailers whose profits rely on these card partnerships. Will a preemptive credit crunch begin today, triggering a market-wide crisis? A scenario no one anticipated. The dream of easy money in 2026 is evaporating right before our eyes. The inflation data is sticky, the Federal Reserve is under siege from political pressure, and the market is realizing that high for longer isn't just a slogan, it is the operational reality for the entire year. The major indices are flashing severe divergence signals. While the Nasdaq Composite managed a meager gain of 0.16% thanks to a handful of mega cap tech names, the Dow Jones Industrial Average slumped nearly 1%. The S&P 500 drifted lower, masking a brutal rotation under the surface where declining issues on the New York Stock Exchange outnumbered advances by nearly 2-1. This is not a broad rally. It is a defensive crouch. Why is the sentiment shifting so rapidly? This morning's producer price index release hit the market with a cold reality check. Wholesale inflation remains stuck at 0.3% month over month, showing absolutely no improvement. Combine this with the bombshell forecast from JPMorgan Chase, which now predicts 0 rate cuts for the entirety of 2026, and you see the foundation of the recent bull run cracking. The market had priced in easing, now it must price in stubborn persistence. This creates a dangerous policy trap for Federal Reserve Chair Jerome Powell, who is already facing unprecedented political pressure following a Department of Justice subpoena regarding internal Fed matters. The bond market is reacting nervously, with the 10-year Treasury yield stabilising near 4.2%. Analysts warn that if yields break higher from here, the valuation math for the S&P 500 trading at 21 times earnings becomes mathematically difficult to justify. We are witnessing an immediate capital reaction to this new rate reality. Investors are aggressively fleeing interest rate sensitive sectors. Real estate and utilities, which act as bond proxies, were the day's worst performers. Conversely, capital is rotating towards sectors that can survive without cheap money. This explains the resilience in the financial sector. JPMorgan Chase reported a record $57 billion in annual net income. Despite a muted stock reaction, the signal is clear. Big banks are printing money on high net interest margins. Furthermore, the regulatory shift toward capital neutral Basel III rules is a massive tailwind, potentially unlocking hundreds of billions of dollars for buybacks across the banking sector. In the technology space, the narrative is narrowing to pure execution and infrastructure. Alphabet surged 2.5% after confirming a massive partnership to integrate its Gemini AI into Apple devices. This deal is critical because it secures distribution to 2 billion users, validating Google's heavy AI spending. Meanwhile, Intel shocked the market with a 6.5% rally, significantly outperforming the broader semiconductor sector. This move signals renewed investor appetite for domestic manufacturing and data center infrastructure, even as other cyclical names like Caterpillar and Nike faced heavy selling pressure due to growth concerns. The market rhythm has shifted from broad optimism to selective survival. The next few sessions act as a critical observation period leading up to the January 29th Federal Reserve meeting. The key indicator to watch is the 10-year Treasury yield. If it pushes toward 4.5%, the pressure on equity valuations will intensify. Smart money is watching the divergence between banking resilience and industrial weakness to determine if this is a healthy rotation or the start of a deeper correction. The most unexpected news in the tech world today has to be this stunning reversal in the US-China tech war. The US government has approved chip giant Nvidia's sale of its advanced H200 artificial intelligence processors to China, despite intense national security concerns. A while back, we talked about Washington's deliberate compute ceiling strategy, and today's move is the first real test of that strategy's flexibility. But this is where the situation takes a more complex turn. The deal comes with an unprecedented condition proposed by former President Trump. The US government will collect a 25% fee on all sales. This isn't a tariff, it's a direct cut of Nvidia's revenue. And as part of the approval, Commerce wants assurances that US buyers are supplied first, while Chinese customers implement security procedures and attest to no military use. Some analysts are already calling this a tariff as a services model. This creates a brand new playbook for trade policy, moving from blunt instruments to highly specific, flexible tools that could be applied to other sectors. We previously noted that data center electricity demand is set to surge, and a targeted fee layered onto that backdrop could become a template without derailing the build-out. This decision puts Nvidia, ticker symbol NVDA, directly in the middle of a geopolitical tug-of-war. For months, CEO Jensen Huang has lobbied Washington for access, arguing it's essential for American competitiveness. The approved H200 is Nvidia's second most advanced processor, with its top-tier Blackwell chip still blocked. Actually, this is a textbook example of a tiered decoupling or N-1 strategy. The N stands for the newest generation. By allowing the sale of the N-1 chip 1 generation behind the best, the US aims to keep China from accessing the most cutting-edge military-grade tech. Even China's best domestic alternative, Huawei's Ascend 910C, is estimated at roughly 60% of Nvidia's H100 performance. Allowing the H200 keeps the ceiling intact at the top end, but introduces a good enough path for Chinese firms. So why would Nvidia agree to this? It boils down to a strategic choice between margin and market share. CEO Jensen Huang has publicly noted that Nvidia's market share in China's advanced AI chip sector fell from over 90% to nearly zero because of prior US restrictions. By accepting this fee, Nvidia is prioritizing a presence in the massive Chinese market to fend off local competitors. It's better to have a smaller slice of a huge pie than no slice at all. Beijing has fired back, with an embassy spokesman telling the BBC that China opposes the politicization and weaponization of tech and trade issues. This follows reports that Beijing previously ordered its tech firms to boycott Nvidia, prioritize homegrown chips. This sets up a fascinating real-world test for Beijing's industrial policy. The question now is whether China's tech giants, like Alibaba and Tencent, will follow the state's directive to buy local or opt for the superior performance of Nvidia's H200 chips. Their decisions will signal whether commercial incentives are trumping national self-sufficiency goals. Heading into the open, watch for any news or pre-market analyst notes on their purchasing intentions. While Nvidia will be happy to get any revenue from China, the real story is the precedent. One analyst warns this unique 25% fee model could expand to other sectors, fundamentally changing the playbook for US trade negotiations. This sets up a critical test for the market. Watch for major movement in Nvidia's stock ahead of the bell, as traders digest not just a massive sales approval, but a potential new strategy in the ongoing economic conflict between the world's two largest economies. Speaking of government shaking up markets, a battle is brewing between President Trump and America's biggest banks that could rattle the entire credit card industry. The flashpoint is a new demand from the president to cap all credit card interest rates at 10%. To put that in perspective, the current national average is nearly double that, at 19.7%. The reaction from Wall Street has been swift and defiant. JPMorgan Chase, stock ticker JPM, is already signaling a major fight. When asked if the industry would sue, the company's CFO, Jeremy Barnum, said everything's on the table, adding that the bank owes it to shareholders to fight back against weakly supported directives. The core argument from the banks is that a forced rate cap won't lower costs for consumers. It will simply reduce the supply of credit, hurting the economy. Now, get this. The immediate danger isn't even the policy itself, but the threat times of it. The mere possibility could trigger what's called a preemptive credit tightening. And here's where it gets interesting. Recent Federal Reserve surveys already show lending standards are tight. So banks might start pulling back on credit offers and raising qualification standards now, curtailing credit access and slowing consumer spending before any policy is even enacted. This decision brings both direct hits to banks and comes with inherent risks for seemingly unrelated sectors. It exposes a vulnerability many investors overlook for companies like airlines and major retailers, these co-branded credit card programs have become a critical high-margin profit center. Delta Airlines, ticker DAL, revealed its partnership with American Express, ticker AXP, generated a staggering $8.2 billion in revenue last year alone. Delta's CEO warned that a rate cap would, in his words, upend the whole credit card industry. And the shockwaves wouldn't stop at the US border. This could quickly become a global issue. A credit contraction in the US would curb American consumer spending, especially on discretionary goods. This directly impacts export-driven economies. For a country like China, which relies on exports, a slowdown in purchases from American consumers could negatively affect its manufacturing sector and employment. So, at the open, this isn't just a US story, it's a global trade story too. With a proposed start date just days away, the political directive is on a collision course with corporate America. Ahead of the bell, watch for volatility in the financial sector ETF, ticker XLF, which tracks major banks. Also, keep an eye on the stocks of companies with major co-brand card partnerships like Delta, ticker DAL, as they are now directly in the line of fire. This is a crucial test of executive power versus market rules, and that uncertainty could elevate risk across the entire market.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.